Today, we're going to trigger a complete paradigm shift in how you view the traditional banking system. We literally interact with banks almost every single day, yet most of us fundamentally misunderstand how they actually operate behind the scenes. Now, our goal in this explainer isn't to demonize the financial system, because we absolutely need it, but rather to decode it. By leveraging some deep dive data from within the financial sector, we're going to expose the everyday mechanics of banking. Once you see exactly how this machine is built, you can stop leaking money and start making the system work for you.
Okay, let's dive into this. Here is the absolute foundational truth you need to internalize before we look at anything else. Banks are not your financial partners. They are businesses, and they are extraordinarily profitable businesses at that. We kind of have this habit of projecting a comforting paternal role onto our banks. We trust them to safeguard our future, assuming their main goals are financial wellness. But just like a grocery store wants you to buy more groceries, your bank has a core product they want you to consume. And if you don't know what that product is, you are almost definitely overpaying for it.
So there's this massive disconnect between consumer perception and banking reality. Consumers think banks are in the business of selling wealth, safety, and security. But what banks actually sell, their most profitable and highly prized product, is debt. The absolute ideal scenario for a bank is that you carry as much debt as possible for as long as possible at the highest possible interest rate. The more money that flows from your pocket into theirs as interest, the more successful their business model becomes. Honestly, understanding this one singular fact changes the way you'll look at every single offer they send you in the mail.
Section 1. Designing the debt trap. Let's look at exactly how banks hook you.
$6,000. So where does a number like that come from? Well, let's say you've got a $5,000 balance on your credit card at an average 22% interest rate. You decide to be super responsible and pay the minimum payment printed right there on your statement. Well, that minimum payment is carefully calculated and not for your well-being. It's calculated to keep you paying forever. If you only pay that minimum, it's going to take you over 15 years to pay off that $5,000 balance. And in the process, you will pay over $6,000 in interest alone. That is literally more than the original balance itself. The bank isn't required to make this math obvious to you, and trust me, that is entirely by design.
Right, so let's talk about the infamous credit card grace period. Most cardholders just assume that if they pay their balance, they don't pay interest. And sure, that's true. But here is the absolutely critical catch. This brief, interest-free window permanently disappears the absolute second you carry any balance forward. If you leave even $10 on your card at the end of the month, boom, the grace period is gone. Once that happens, interest begins accruing on all your brand new purchases immediately, right from the date of purchase. Partially paying a balance doesn't magically restore your grace period. It really just slows down the bleeding. Banks bury this little mechanism deep in the cardholder agreements.
And this brilliantly illustrates the ultimate debt product, the 30-year mortgage, nearly $500,000 in interest. Let's break down the arithmetic here. If you buy a $350,000 home with a 30-year mortgage at a 7% interest rate, by the time you make your final payment, you haven't paid $350,000. You've paid roughly $836,000. The bank earns a staggering $486,000 in pure interest from this single transaction. It makes the financing significantly more expensive than the physical house itself. Again, this isn't some shady scandal. It's just compound arithmetic that banks conveniently never visualize for you at the closing table.
Section 2. Draining your wealth quietly. Let's talk about passive bank revenue. The average bank savings rate at a major U.S. bank sits at a microscopic 0.5%. Meanwhile, average annual inflation hovers around 3.0%. So what does this actually mean for you? It means every single dollar sitting in a traditional savings account is losing roughly 2.5% of its purchasing power every single year. Your money is slowly evaporating. Meanwhile, the bank is taking your exact deposits, turning right around and lending them out to other people at 7, 10, or even 22%. They profit massively off the spread, while your so-called safe money technically shrinks in value.
Then there is the overdraft fee. This is a multi-billion-dollar revenue stream. Have you ever wondered why you might get hit with 3 overdraft fees instead of just 1? I promise you, it is not an accident. Many banks deliberately process your largest transactions first rather than in the actual chronological order you made them. Why? Because the large transaction drains your balance instantly. Then your 3 small $5 coffee purchases suddenly trigger 3 separate $35 overdraft fees. You can actually call and opt out of this overdraft protection, which just means your card will decline instead of charging a fee, but banks absolutely will not volunteer this information to you.
Now this quiet drain totally extends to your investments too.
There is a staggering difference when it comes to 401k fees. If you have a $200,000 base portfolio over 30 years and you're in a fund with a 1% annual fee, which by the way is incredibly common, you'll end up with $1.15 million. But if you just switch to a low-cost index fund with a 0.03% fee, you end up with $1.48 million. That is a $330,000 difference. That entire sum is quietly transferred to the fund company without a single warning pop up on your screen. It's a massive wealth transfer disguised as a tiny little percentage.
And hey, if a bank-affiliated advisor ever pitches you whole life insurance, keep this in mind. Whole life policies are notorious for being wildly lucrative, just not for you. They're lucrative for the person selling them. Commissions on these policies are frequently 50 to 100% of your entire first year's premium. For the vast majority of consumers, buying a simple term life insurance policy to protect your dependents and then just investing the difference in cost into low-fee index funds produces dramatically better outcomes. The person who benefits most from a whole life recommendation is almost always the person making it.
Section 3. The penalty for loyalty. Why staying put actually costs you.
Let's start by totally redefining the credit score. We obsess over this number as if it's a definitive grade on our personal financial health. It's not. The credit scoring system was created by lenders for lenders to assess the profitability of lending to you. A perfect credit profile for a bank is absolutely not someone who pays cash for everything and owes nothing. Their ideal customer is someone who reliably carries moderate balances, uses multiple credit products, and generates steady, predictable interest revenue over a very long history. Once you realize it's a profitability score for them, you can stop managing your money to please a metric and actually start managing it to build wealth.
Now, what's really interesting here is the stark contrast between loyal long-term customers and brand new ones. You'd naturally think being with a bank for 20 years would earn you some serious VIP treatment, right? Statistically, it makes you their least well-served demographic. The banks allocate their massive budgets toward customer acquisition, not retention. Brand new customers get the highest promotional interest rates and get their initial fees waived to entice them in the door. The loyal customer who just stays put, they get dropped to the standard, lowest yield rates and get charged all the standard maintenance fees.
Which brings us to a powerfully succinct truth. Your inertia is their revenue. The customer who never reviews their monthly statements, who never calls to negotiate a fee, and who never compares their interest rate against a competitor is literally the most profitable customer a bank can possibly have. They are relying entirely on the fact that you are too busy or too overwhelmed to move your money. Your lack of action translates directly onto their balance sheet.
Furthermore, banks constantly market this idea of consolidation. They tell you it's so much simpler to keep your checking, savings, mortgage, and credit cards all under one single roof. And yeah, it is convenient for them. By consolidating, you entirely eliminate your negotiating leverage. When all your money is tangled up in one institution, the switching costs, like the time and effort to move everything, are incredibly high. The bank knows you're trapped, which means they have absolutely no incentive to offer you competitive rates to keep your business.
Section 4. Taking back your power. Here is the counter playbook.
First up, let's talk about the debt escape hatch your current bank will absolutely never mention, the 0% balance transfer card. If you have credit card debt, there are cards out there that offer 0% interest for 12 to 21 months just for moving your balance over to them. Under a 0% introductory period, 100% of your payment goes directly to destroying the principal. If you stick with your original bank on an $8,000 balance at 22%, you are giving them over $3,000 in pure interest. The moment you initiate a balance transfer, their interest revenue stops dead. And that is exactly why they won't suggest it.
All right, here is your rapid-fire consumer counter playbook. Step 1, move your emergency fund to a high-yield savings account, or HYSA, today. They currently pay 10 to 15 times the rate of traditional banks. Step 2, make just one extra mortgage payment a year. Doing this applies directly to the principal and can shave roughly 7 years of interest off a standard 30-year loan. Step 3, pick up the phone. Call the number on the back of your card. Late fees, maintenance fees, annual fees. A single polite request can often get these waived instantly. And step 4, separate your accounts. Force institutions to compete for your business. Checking at one, savings at another, investments at a third. Competition naturally creates better terms for you.
So, I want to leave you with this one final critical question. Is your money working for you or your bank? Look, the banking system is not some evil conspiracy rigged against you, but it is an incredibly sophisticated machine designed to collect from you passively, silently, and legally for as long as you allow it. But now that you have the data and the playbook, you have the power to stop allowing it. Every fee you negotiate, every debt you crush early, and every dollar you move to a higher yield stays right where it belongs, with you. Thanks so much for joining me on this explainer. Now go take control of your capital.